I guess we should get started. Somebody might stumble in here. We do hope we have interaction during this group. This is pretty, I think, very interesting. I'm Don Williamson, and I direct the National Tax Program over the CODOT School. I'm joined by Caroline Bruckner, who's the Managing Director of the CODOT Tax Policy Center, and Ben Leff from the Law School. We all teach introductory tax courses. And as the description of our session, the popular impression is that the study of taxation is mundane. That's not my word, I won't tell you that. The session, and so we're going to look at some presidential tax returns that might offer some enlightenment about certain topics that we covered in the intro course, and also just peek under the covers a little bit to see these returns. So that's our goal, and we do hope that you ask any questions. I have the entire returns of the president's here, and I just want to encourage anyone who has any questions about these folks that we'll look at them in some detail in some cases. Turning to, I had to do this.
Is it okay if I turn off this light?
Oh, sure, please. I had to do that. Don't turn them all off. But I had to do that because that was what came from Wall Street Journal about a week or two ago. And this has been a really hectic few weeks for us all with the new tax code. And we're not here to talk about those because we won't have to do it break. But it isn't very often that the tax accountant gets to be the center of attention in those situations, particularly with holiday parties. So that was great. Yeah, I guess that fellow forgot his pocket protector. So that's good. The current practice on disclosure, I want to emphasize to everybody in this room that your tax returns aren't going to be looked at by people like us. We are simply able to get this information because the president's voluntarily released them, all but one. And so we have been able to look at this material, and it's been very useful in examining stuff for the class. And we try to excite your students about this, and it is kind of exciting to see that the President of the United States is a regular person, just like you and I. Maybe sometimes, often not, but sometimes with more zeros at the ends of his numbers that we have, but often not the case at all. And there are problems and issues, and the way they address them, and the way they reflect them in the tax return is similar to you and I. And that's why we use this in our classes, just to, like the room we have. And we're just lucky that these folks generally are willing to release their returns. We have a lot. Yes, please.
To set the framework for the discussion, I wanted to include this slide that talks specifically about what the rules are to give you just a little bit of background of the meat that Don's going to go into. It's important that students know that their privacy is protected, right? But presidents are held to a slightly different standard, and it's been tradition since Nixon that they voluntarily disclose their returns as part of the debate that goes forward during the campaign season. Now, like all other U.S. presidents, like all other citizens, U.S. presidents do have a right to privacy that is protected. However, there's a caveat to that general rule that there's no required disclosure on any returns, in that Congress has retained the right to publicly disclose presidential returns, specific to presidential returns, and that right is retained by the tax writing committees. So the committee on the Senate Committee on Finance, as well as the House of Representatives Ways and Means committees, retain the power to compel and disclose presidential returns. That's an important piece of information that will likely come up, and you'll see that being litigated during the 2018 campaign season. You can see the campaign heat up for protection of the House. Now, even though presidential candidates and presidents aren't required to disclose their tax returns, they are required to do a minimum level of financial disclosure by the FEC. And those returns they're not returns, but those disclosures are in fact different from returns. So I went ahead and highlighted on the next slide the differences of information that you can find from a FEC filing versus a tax return. And this is something that you can just Google and pull up from an article that I pulled on the Sunlight Foundation. But one of the things that is important, and Don's going to talk about this throughout the rest of the lecture, are the differences of and the types of information you can find from a tax return and a financial disclosure that is compelled by the FEC. Also, different penalties apply with respect to misrepresentations on an FEC filing as well as a tax return. So that's just something I wanted to highlight, the key differences being that on a tax return, You learn yearly annual income, what the candidate paid in taxes, what deductions and credits were claimed. This can be really important. It was detrimental in many respects to Nixon's presidency, which we'll talk about that in a little bit. You can also see how much a candidate gave to charity and what charities, that illustrating their types of priorities that could be important going forward in setting their legislative agenda. You can also learn who the candidates are in business with, who they owe money to, as well as if any money is being held offshore. That's different information than that is generally required on the disclosure form. One other thing I did want to point out, which I did not know that I stumbled on last night, I did not realize that presidents are required to be audited by the IRS. So every president and vice president, so long as they are in office, are subject to a mandatory audit. Now again, just because you're under audit does not compel any kind of disclosure requirements, but that's something that I had not realized was part of the IRS manual. But I think it's a point of key information that I would suspect is going to be relevant again in moving forward as we continue to litigate publicly whether or not a presidential return should be compelled. Lastly, I wanted to go ahead and highlight the current status of the returns. We're going to talk about specific examples, but I wanted to illustrate what returns are currently publicly available. You can find this information on the Tax History Project's website, which is an awesome project that is being run by our friend Joe Thorndike, who is the leading tax historian in the country. He's been very kind to the COGOT Tax Policy Center. He has been a wonderful friend to us. But these, he has been tracking what has been released either through presidential libraries or has otherwise been publicly disclosed with respect to presidential returns. We can make these slides available, so you can go through and click on. These are all active links for all of these, for all of the current returns that are disclosed. But one thing to keep in mind when you look at this entire list is that the individual income tax has only been instituted in this country since 1913. There's a reason why it doesn't go back even further, and it's primarily a 20th century phenomenon, but it's really been since the 1970s and the controversy over the Nixon tax returns, which really gave rise to the tradition of disclosures of presidential returns. Lastly,
can I just interrupt for a second
yeah.
on the last slide? Just to clarify that the Trump return is just 2 pages out of what is undoubtedly a 100-page document. And it wasn't disclosed, it was leaked.
It was leaked.
And so we actually don't have the 2005 return of Donald Trump. We have 2 pages of it.
Right, but we do have a financial disclosure that was required by the FEC, but you can't verify the information on the financial disclosure with respect to cross-referencing it with the tax return, which is an important piece of information that congressional committees have indicated to the Treasury and IRS privately that we know of because we've talked to staff. That's pieces of information that they're going to be requesting should ongoing as the Democrats look forward to what kind of legislative, and we'll talk about this at the very end of the session, what kind of legislative strategies they may consider given Donald Trump's departure from established practice for presidential candidates and presidents disclosing their returns. The last slide that I put in here is on the current practice and disclosure of presidential candidates. So you can also see what candidates have disclosed what. And it really does, in fact, illustrate how the voluntary release of tax return is considered to be a legitimate part of the campaign discourse in a presidential campaign. And, you know, even the latest polling on this, which I was reviewing last night, still 70% of the American public indicates, at least in one poll that I read, that they would prefer to see presidential candidates disclosing relevant tax returns. So, with that background,
I have a question. Would the method be disclosed?
no, the IRS does not have the authority to disclose anything. But what's relevant to that is that the congressional committees do. And with respect to Nixon, they compelled the Joint Committee on Taxation conducted their own independent audit of Nixon's returns and made those public. And the IRS conducted a separate audit and found discrepancies in some of the deductions that Nixon had claimed, which we'll talk about in a little bit.
Yeah. But what is the timeline? Because Donald Trump did not disclose because the argument was I'm under audit and therefore until it's completed.
Right, so
Not
it was
disclosed.
part of the campaign that was litigated, and the voters did not care. Donald Trump won the election, and what I think is important, and the reason that I included that last bullet is to let you know that under law now, or at least under the IRS revenue manual, the president and vice president those audits are in fact mandatory. So that could in fact be part of the general campaign discussion that moves forward should Donald Trump decide to run for re-election, but that's where we are in the general ether.
So there's plenty of information there that will appeal to your current interests. What we try to do in our classes is to select certain portions, certain returns to illustrate matters that we're discussing in our classes. So we turn, for example, as Caroline mentioned, the state federal income tax began in 1913, and we have Franklin Roosevelt's 1913 tax return.
Which he did not voluntarily disclose.
It was in the Hyde Park Library.
He did not want to make his returns public whatsoever.
Well, as you see, and the reason we use this in the classroom is to show that, if you look at the return, the tax began at about 1% for those making between about $10,000 or $20,000. And if you were a really heavy hitter making $500,000 a year, you paid 6%. And very little deductions, as you see in this form, not very much going on there at all. And so we start that discussion just to introduce the students to here is how the federal income tax began. Then we turn, and again, this is being totally selective. I think FDR's 1937 return. I like this one just great. It shows how the world has changed to the edginess that we are expressing today versus the olden times of 1937, where the President of the United States sent his return over to Guy. And Guy happened to be the commissioner of the IRS. And you see, dear Commissioner Elbring, I'm enclosing my income tax return for calendar 1937 with a check of $15,000. As this is a problem in higher mathematics that I cannot figure out, just let me know if I need to pay more. Sincerely, Franklin Delano. Now, in 1937, we did not have, you will note here, Eleanor's signature is not here, because we didn't have joint returns until 1943. And I can't find hers. And I don't know how much money she made or where it came from. But what this is used in the classroom to illustrate is, okay, you, junior, senior, whatever you are, think you're majoring in accounting, which is desperately need more of. But you're so daunted by this technical stuff in 443 that Carolyn teaches, or the introductory course that Ben teaches, that this is so daunting and so technical and so overwhelming. Well, I would submit that the greatest political figure of the 20th century in 1937 was overwhelmed by the intellectual code.
And that's
much more
simple.
Much more simple.
And that was before Republican.
Well, so, and I mean, this is just another tie-in that, there is a political movement now to have, what in California is called ready return, but some mechanism by which, in fact, you just send your information to the IRS and they compute it for you. And it has been blocked by the very effective thing. So we could have a system that worked like this, where the IRS had access to all the information that they need to compute your taxes, and they do it for you, but we don't have that system.
We are unique in the world. We are a self-assessment system. If you speak to foreign nationals and tell them how they have to file a tax return in this country and pay the tax, the initial response is, why? Who tells me to? Well, no, you file the return and you file it yourself, and then you pay the tax. Why? They come from cultures and systems where the government, exactly what you described then, sends you a bill. And then you pay it, or you don't pay it. But nowhere else in the world do you actually derive your own taxable income from your own tax. And I did a gig in China a few years ago, and the Chinese are absolutely amazing. They consider us to be enemies. They just sort of jump off the cliff and voluntarily pay tax. So, but this, to get back, this is a conference on pedagogy. Our pedagogy here today is to introduce the students that, yes, the federal income tax is very complex, very difficult, very hard, but so do the presidents of the United States consider them so daunting.
One of the other things that I like to point out when I discuss these types of returns is the political implications and how the development of tax law reflects a political ideology. Oftentimes, I think it's important to give comprehensive context so that people don't, or students rather, don't assume that taxes occur arbitrarily, that they are the result of a very decisive political decision making that happens either in the executive branch or at the electorate level. So, for example, with what we were talking about with respect to the California example that you gave, one thing that I would point out to my class is one of the political considerations and the reasons why California has been unable to move forward in the legislature with trying to have automatic returns being prepared is, I would suspect that Intuit, which is the parent company of TurboTax, is located in California. And I think it's very important to highlight not only the historical perspective. Americans are very funny about how we pay taxes and why we pay taxes. In many respects, this is one of the key factors for the American Revolution. It is also a key factor for the Whiskey Rebellion, which was actually all about tax. And in addition, these are the things that I like to point out about how tax policy and tax questions, Americans are very funny about, but we have a long illustrative history, and that these specific tax issues don't just happen in the vacuum, they're part of our American fabric history.
In terms of Richard Nixon's already referred to the Nixon return from 1969. I just put up
good.
The Schedule B there, the sale of his home. He moved from Park Avenue to New Jersey back here, and so he sold his home. And so we have currently in the Internal Code a provision about how you don't have to pay tax on the gain of your home if it's under a certain amount. At this time in the law, there was a rollover provision, and we're not here today to discuss historical tax provisions, but it illustrates that even presidents sold their homes and didn't have to pay tax on the gain, or was subject to certain rules regarding the non-recognition of gain. So when we reach that chapter in the text, we throw something like this up. Now, I only put a portion of the attachment to President Nixon's return regarding the charitable contribution deduction that he made in his physical papers for $576,000.
Papers to the National Archives. He took a deduction for designating his political papers to the National Archives.
And there is a pretty good argument at that time in the law that that was probably legal.
Totally legal.
So they had to change the code to deal with that. So that now you are limited, in the way it is now, for self-created assets like your own memorandum. You are limited to your adjusted basis, the cost of it. But there was a very nice, I can't put everything here on the screen, but it's all here in the return if you want to look at it. A very good appraisal. We show the students that. Very logical appraisal with an 8283 form, valuing the Nikita Khrushchev box. We went to Russia, Nikita Khrushchev came here. And then all of his vice presidential papers, all valued by a reputable appraiser in Chicago for $576,000. I wouldn't have done it that way personally. I would have spent it over 2 years because there's AGI limitation rules, but they don't ask me.
But it's also important to talk about how the political controversy, one of the things that really illustrates how politics and tax are so inextricably entwined, is how this deduction gave rise to an investigation, and an investigation that was delegated to the Joint Committee on Tax, which is a bicameral, bipartisan committee made up of members of the Senate Finance Committee and the House Ways and Means Committee, who did a formal auditing of the president's return. And the resulting political controversy regarding that is actually what gave rise to the very famous Nixon quote, "I am not a crook." It was not in relation to Watergate. It was, in fact, in relation to his tax returns. So one of the most famous statements Nixon ever uttered was really all about tax. And ultimately, there are those of us that believe that tax was almost as important as Watergate in bringing the end to the Nixon presidency.
All of life's issues are simply one tax.
Well, and there's another interesting legislative issue that arises from this because the provision that was, again, I don't know how much the story of the legislative history is accurate or not, but the legislation that followed from the correction of this Nixon loophole applies to all self-created works. So if you're an artist, there's an extreme effect on your ability to donate your art to a museum, for example, that came out of the particular way that the craft of the legislative response to this particular thing. So there's a whole variety of ways you could have responded if you were upset that a president is donating materials that were produced while he or she was president, you could have a legislative response that says, well, the stuff that you produce as the president, you're acting as the agent of the government and it already belongs to the government, so you can't give it back to me and donate it. Instead, they said all self-created works cannot be donated at their fair market value, and it has this very strong level effect. So don't matter.
This is something that I try to emphasize with our BAE students who are arts and entertainment students in the business school, who I really try to make tax as relevant for them as a integral part of their decision making that they'll have to really adopt and understand as business managers going forward in their career. This is something that I spend a lot of time on, but Nixon gives us the foundation in which to talk about it.
And again, as we go through this, we're trying to inject real life into our classes. Don't just read the chapter, you follow it too. You know?
J.K. Rowling is great for this.
Let's go to the Reagan return. We have the Reagan return from 1987. I chose this one because this is the introduction of the presidents using blind trust. Now they're using blind trust. Also, I get a kick out of this return. This is the last presidential tax return really that is done by hand. Gibson does the Crutcher with this. You probably do business with them. The law firm out of LA for this. Caroline mentioned about, and it is very important, I'll mention this because we have a Schedule B for, so there was questions at the bottom about foreign accounts. The only one I found to date to check yes to that is wrong. With you as well. With all the PFICs. So
What's a PFIC?
the passive foreign investment company.
Okay, and that is?
That is okay. It's a foreign company owned by any percentage of which is owned by a U.S. person, where either 50% of the assets of or 75% of the income of is passive, such that distributions from the company at any one year is allocated over the shareholder. You know, I'm going to go on and that's that.
It's an example of how you can have a foreign investment and perfectly legal.
Perfectly fine.
But it's something that we require to be disclosed on a tax return.
Yeah, and that's why this spring we'll be using the Manafort indictment. That's what they got Manafort on, is checking no to this box. Yes. So we're going to do crime and tax research and procedure. We'll use his indictment. So again, the blind trust.
I'm sorry, just on that, on the PFIs. PFICs. That's different than what the Panama Papers and the Paradise Papers revealed.
Oh, geez, I don't know very much about the Panama Papers, other than it wasn't too many U.S. persons that had the Panama bank accounts.
But all of the, so that's a tax characterization of, it's not a specific structure, it's a tax characterization of a range of investments, many of which could be the kinds of accounts that were described in the Panama Papers.
And the Paradise Papers are even more damning, yeah.
But the idea is that your tax return, which is where you would notice this that's where you give notice to the federal government. And one of the ways that you give notice to the IRS that you actually have these investments is not required to be disclosed, right? But the Panama Papers were in fact disclosed separately. So any differences between what was disclosed in Panama Papers and the tax returns is going to give rise to.
Yes.
And you should identify. If you have foreign bank accounts, you should identify. You're required.
Yeah. You're required to identify a foreign bank account.
No, you should already apply.
Unless you're borrowing lots of money from Russian oligarchs who are funding your empire.
It could be completely disclosed, we just don't know.
Let's go on to the next one. Let's go on to the attachments to the Reagan return. Because I wanted to demonstrate just how expensive this business can be. The preparation of Ronald Reagan's tax return, this is 1987 return, so it was 1986 federal income tax return. He was charged $7,800 for in 1986 dollars. So you can more or less triple that today. So this is the $20,000 return. And that's what you have to have in these cases. You've got to be able to pay this kind of money type of return. Clearly, the Romney return, for example, is much better. As we probably Trump return. You also saw, as Carolyn pointed out, the returns were audited, so there were separate bills there for the audits, for each audit. And any tax professional, we discussed this in class, a tax professional would do a return for a certain fee, and then if that return is audited, it would be a second fee. And that's exactly what gives us that pressure here. It's interesting, under the new law, none of this will be deductible. Let's go to
The
the
new
Bush.
tax reform law.
Yeah.
The new law, not this one. Let's go to the 1991 Bush return. I selected this one because Bush took the whole idea of the blind trust that Reagan created. And the reason you talk about blind trust is Reagan, or if you have a blind trust, it's still a grantor trust for federal income tax purposes, and you still report all the income on your 1040. It's just you don't know where it's coming from. Okay. But Bush still took this to a whole other level, and Bush did not even look at his tax return. Go to the next page where we have the letter. The letter is from President Bush to the district director of the IRS saying, I don't want to even look at my return, and I would like Bessemer's Trust to sign my tax return for me. Now, I have no personal experience at this point. This is really unprecedented. But what the Bushes decided to do is we will totally divorce ourselves from the return and have someone else prepare and sign as the taxpayer. And I didn't put page 2 of the return down, but it says the Bessemer Trust person, or George W. Bush by the Bessemer Trust trustee. I also chose this one because it shows the example of a power of attorney that our students, if they major in accounting, become CPAs. They will represent taxpayers before the IRS. And the 2848 form, I can't see we have that one. The 2848 form would be completed and signed by the Bushes. And they did. You see on that page where they signed their name, Barbara and George signed. So from that moment on, the IRS would only communicate with the Bessemer Trust people and not with the Bushes themselves. And very often you would attach such a form to your return if you didn't want to talk to the IRS. And many people don't want to talk to the IRS, and you simply attach this to the return. Again, I include this as a conference on pedagogy, not tax planning. But we include this in our materials to demonstrate to students how they will be representing their clients before the Internal Service.
Now, the Bushes cannot get out of the responsibility for accurate tax filing, the responsibility for paying the correct tax. It just is passing off the communication.
Right. There's 2 levels of penalties, of course. There's the penalty the Bushes would pay for either negligence or substantial overstatement of income. There's appropriate penalties, but there's also the tax return prepared penalty. And we communicate to our students that when you are representing a client and your name goes on the tax return, it's like your own return. And you are as responsible for the accuracy of that return, or at least the information on the return, as anybody else, as the taxpayer themselves. And sometimes you get these finger pointing issues. I'm told them, no, we didn't, yes, we did. But that's basically what we're doing. Just question that? No? Okay.
I think that there are 2 other important points to point out here. Number one, they did this knowing that these returns were going to be subject to mandatory audit, because the president and vice president's returns are subject to mandatory audit, number one. And number 2, it's reflective of the Bushes' political ideology to remain above any kinds of political arguments that they could have any kind of conflict of interest. And that's, some of the political machinations behind why you would want to have this kind of blind trust and designate this kind of authority if you're in that level of power, because there are always going to be allegations that there's a conflict of interest with respect to the president, their returns, and the IRS, and the ability to appoint the IRS commissioner.
If you've made this decision, you lead a political life, you have to make these kind of decisions that you're just going to give up anything beyond your tax return. And I've done these returns, particularly when administration's transition. People come and say, I want you to help me with this, and okay, and if there's any issue, I want to decide it against me. Any issue I want to decide against because I want to be the deputy undersecretary's assistant deputy at the end of the returns. So that's a whole other issue. Let's turn, ladies and gentlemen, to the Trump return. You've all been waiting for it. Now, as Ben pointed out, we only have these 2 pages. This preparer X'd himself out. There's some guy in Florida that does this sort of work. I call your attention to the numbers. If you look at that interest number and what kind of interest you're earning in 2005 and divide that by 5% or something, you get $100 million for that cash. But if that impresses students, you want to talk about that. Whatever it takes to grab the students' interest and keep them into it. All I can do on this return is point out line 21, where you have that $100 million loss. That is probably a net operating loss. I don't know, but that's where I would put an NOL carry forward from subsequent And these people have good years and bad years. Bad years, they lose money, and so the NOL is probably carried. That's probably what that is. So if we were using this return, I don't use this return in my class, but if we were using this return, I selected it just because I really want to see it. But if I was using this return in class, it would be to demonstrate the net operating loss. So at some point, somebody lost $100 million in this case. And we do have page 2. I'll just point out the little interesting wrinkles. He had more than one W-2. You see over there on line, I can't read it, it's so small, $1,000 on page 2. What is it? No, it wouldn't help. Yeah, the 1,427 there on line 87. This is sort of detail. I don't want to go into. He clearly had 2 jobs because that's the excess 5. That's the excess 5.
Well, he worked for NBC.
Well, I'm sure he did, but I'm saying he had 2 jobs.
He was on TV every week.
But just simply illustrate, you may have 2. I don't know. It's your life. But the excess over the 120 does become credible against your income tax in that case. Okay.
Actually, before you move on, I just want to. So I don't use presidential tax returns all that much in my class, and partly it's that I'm not so interested in talking about the things that you can learn from the return about the president because my class is not the tax class. But I do use a presidential candidate return to illustrate a few basic things just about those first 2 pages. And so I just wanted to give like a flavor of some of the things that I think are the big themes that it's interesting to look at someone's tax return to find out what they are. So one of the things I like to point out is just about complexity and the tax code. So this is just 2 pages, but it's actually a complete form in a way. There are schedules that you have to attach, but this is the form, the 1040. And if you look at that form, often in political discourse, people are thinking about, let's have a simpler tax code, and what they talk about is the rate structure. So the idea is if you had one rate, if you didn't have to pay, 10% of your first X income or another percent of your next X, Y income, etc. If you didn't have progressive rates, flat rates, that would dramatically simplify the code. That's not on here at all. In other words, all of this is not about what is the rate structure. All of this is about different types of income and then different deductions. And most of the deductions we talked to are not on this form either. They move off into another form. But that whole first page is this box here is all different kinds of income. And all of that is there because we tax different kinds of income differently. If we just taxed income in one way, we wouldn't need to have all of these different boxes, and we could have, with a very progressive rate structure, a postcard return. It's because we're very intent on taxing this box, the box that is the biggest for both of us, which is the money that we earn from employment, taxing this at the highest possible rate, and taxing these other things, dividends, capital gains, at a lower rate. So we have this differential taxation, and that requires them to be separately reported. With Donald Trump, again, you can see how, how much of his income is from things other than this, and how much is from things that are taxed at a lower rate. This actually is taxed at the full rate, so that's a big number too. And then also this big loss, if you think about, okay, well, how much, the second thing that I like to illustrate is how much taxes are we paying? Because all of distributive justice in relation to the tax code relies on being able to think about, if you have different amounts of income, how much taxes are you paying? What is the percentage of that you are paying? That's actually an extremely difficult question to answer. So we talk about it sometimes as if it's easy, as if you could say, like, I pay 25% of my income in tax or something like that. But in order to answer that question, you have to decide what is the denominator of that statement. What is my income? And we usually talk about the denominator is this line that's called adjusted gross income. But you can see how constructed adjusted gross income is. You have these are deductions, these are subtractions from income, and you have all of these kinds of income, one of which is a $103,000 loss that didn't happen in that year. So if you want to know how much did Donald Trump make in 2005, this is actually not this is a terrible number to tell you that. And then on the next page, you have to decide, well, what's the tax number? How much tax is he actually paying? And again, with Donald Trump, if you could see those tiny, tiny numbers, you'd see that actually almost all of his taxes paid in what's called AMT, Alternative Minimum Tax, which is a whole different system that adds on tax depending on what kind of deductions you have. So if you want to answer the question, how much is he paying in tax? If you just looked the way that we traditionally do it, you look at adjusted gross income, you look at the total amount of tax he actually paid, his tax in this year was over 80% of his income in this year he paid in tax. If you do it in the traditional way that we figure out how much tax you owe. If instead you say, like, well, let's take out the big loss that's from the previous year, we want to know how much tax he's paying in this year compared to his income in that year, then he's down to 25%. And if you take out the AMT payments, so you say how much tax would you pay under our tax code ignoring the AMT, he's paying tax at 3.8%. So that's a huge range, 80%, 3.8%. All of those have arguments about why those are legitimate ways to think about how much tax you're paying. It's exaggerated with Donald Trump, but that would be true of a whole range of taxpayers. So that's the kind of thing that I think is nice to do with a specific tax return, just to give the introductory stuff about, well, what are we doing in this class and thinking about how taxes are constructed.
One final point, we will move on. Oh, please.
I like to use this return because I think it illustrates a fundamental concept of tax, which is really important, that I like to convey to our students. The tax code is with you in good times and in bad. And when bad times are bad, they are really bad. And that's what this net operating loss illustrates. It is a very large loss, but the fact that it can be used and carried forward is a decision to help you offset years going forward in the future where you actually have better years. And I think that that's a fundamental principle of the tax code that I like students to leave my classroom understanding that the tax code is not necessarily evil. Yes, we tax you in good times, but in bad, you are given certain preferences due to the concept of legislative grace that Congress has decided that we want to be with you in good times and in bad, and we will let you offset your income going forward with previous losses. And it's also really important for re-emphasizing time value of money concepts and ideas about why it's important to document your losses as well as your successes with just a fundamental principle of time.
Of course, going forward, the new law will teach you that.
Yeah. So.
One other point I will put, again, we could go on for hours. One final point is his tax return preparer screwed up. The $32 million paid with the extension was not enough. And as a result, he had interest and penalties to pay in return. You see that at the bottom of page 2. So as someone who is involved in this sort of work, it is interesting to see when they screw up. And there's a screw up there, no question about it.
Can I just, on your point about how different income is taxed at different rates, I would think a teachable moment with our students would also be that people earning $10 million or more a year only derive 15% of their income from wages and actual salary. Right. 85% of their income is from dividends. And
I mean, as a whole, not just this year.
So they're paying much less taxes on that. So only 15% they're really being taxed like the rest of us.
Absolutely. I mean, all of the questions about what income means at different income levels is, there's no way to think about distributive justice without having a theory of what we call vertical equity. That is, how much should you be paying at different amounts? And the way that we differentially tax has a huge impact on that because we differentially tax different types of income. So I actually have never used this return in a class. The best return to illustrate that in a nice, clear way is Mitt Romney's return. Mitt Romney's return is all calculated.
Oh, it was John Kerry return.
Oh, John Kerry.
Kerry, yeah, she made all the money with all Heinz dividends.
But that's also reflective of a political decision. And my background is I worked in the U.S. Senate. I worked on tax policy, and I like to really bring in the realities of the people making these decisions and how that actually plays out, and the conscious decision that Congress sometimes makes that we want to give preferential treatment, tax treatment by lower rates into investment income. The idea is that you're creating access to capital for businesses, right? So that's the political ideology that sometimes maps onto these rate differentials that people honestly believe. Now, whether or not that bears out to be true is, or changes over time is certainly something that can be subject to future debates. But I think it's very important that we not just isolate these ideas into quintiles or taxpayer rates as much as we understand what is derivative of the political discourse and that leads to some of these decision makings.
Okay, let's turn to the McCain return. McCain didn't make it. He didn't become president, but he did release his return while he was running. And I selected this one because it simply illustrates a married filing separate scenario. That you may want to share your bed with someone, but certainly not your tax return. And so this happens all the time. We see this all the time with married filing separate returns, where people simply choose to operate their financial life apart from their other affairs. In this case,
I mean, with McCain, the dominant theory would be just that he doesn't want his wife's returns to be disclosed, presumably.
well, that's what John Kerry attempted to do with the Heinz return, and she eventually had to release that.
Oh, they filed separately also.
Yes, Kerry and his wife Heinz.
Yeah.
We had that return.
Well, if I may add, if you notice here, it's not just John McCain's, Cindy McCain's return are up here as well. So she did release hers.
Oh, okay.
As well.
You're
Oh, I didn't
not going to want the president to file married separate and release your spouse's return. That's going to happen. That's going to happen. And what is interesting, again, we can discuss this in our classes with students on technical matters. You note that he took one child and she took the other. In fact, probably I would have put both children on his return in order to use the complete dependency exemption rules that no longer exist. Turning to the Obama return. I use the Obama return for foreign tax credit. This is really the best return to illustrate the foreign tax credit. He made a lot of money from the sales of his books in Europe, paying foreign taxes on those sales, and you cannot, you're allowed a foreign tax credit against the U.S. tax to the extent of the U.S. tax against the foreign source of income not to receive the foreign tax. So this simply illustrates that his prepared has always prepared his return for years, and going to the 1116 form, that's where we would walk through these steps of the computation of the foreign tax credit. It can demonstrate that in that case. I should point out all these presidents all list their charitable contributions individually. You can pick any of these guys to illustrate charitable contributions to your class if you choose. But again, he got a full foreign tax credit. You see on the 1116 form, he paid $57.45 foreign tax and claimed the credit of that amount because the U.S. tax on the foreign source of income exceeded $57.45. So it just illustrates that point. We turn to the Clinton returns, and Ben and I have discussed the Clinton returns from 2014. We're curious about why the Clintons did it the way they did. You see they have about $28 million from royalties of their books coupled with their speaking engagements. Here we illustrate the concept of the self-employment tax that they paid on everything. Did I include all the Schedule C's?
What's the
Yes.
self-employment tax?
Okay, the self-employment tax, if you get the W-2 from AU, box 5 of your W-2 will show the FICA tax, 7.65% of the first $120,000, something like that.
So the Social Security and payroll taxes that you pay.
Right. And so as a result, the self-employment tax is someone who doesn't have withholding, so they pay the full 15.3% themselves on this.
And they're required to calculate that and pay that in quarterly payments throughout the year, just like you.
Well, I purposely didn't choose that. What Obama did is he earned all his income in the fourth quarter, so that there's estimated payments that can be lumped in the fourth quarter. I didn't include the 2210 schedule for you because I would put you to sleep. But the point of the matter is, these employment taxes, the Clintons have to pay themselves because they're self-employed. What Ben and I found curious is Hillary had 2 Schedule C's and Bill had 2 Schedule C's. Oh, I had 2, maybe 2. Yeah. So you see the Schedule C for Bill for speaking, where he made a little under $10 million, and then the Schedule C for Bill, where he was consulting. In this class, I would point out that you will note the consulting Schedule C, he did it through a limited liability company, the WJC LLC. I wonder where you got that from. But he did that through a limited liability company, but the speaking fees, he just took a check. It's very interesting. It's half a dozen cents the same in my personal opinion, but it is interesting when he ran some of the business through the LLC and the rest he just took the cash. In both cases, be it speaking and consulting, the self-employment tax had to be paid. And again, a lot of people forget about that self-employment tax. We have a chapter in the book on it, and we discuss that, and so it's the extra illustration. Hillary, the same thing. And what Ben and I found interesting was that Hillary subjected her royalties to the self-employment tax. A strong argument can be made that royalties are not personal service income. They may be the result of effort, but you're basically receiving a return on your capital, the book itself. But again, these folks, the political class, will not, they'll say, pay it, just pay it. I don't want any issues. I don't want to claim gray issues. If it's gray, I want it against myself. That is something we need to communicate to our students. The returns they work on, or the tax research they do, or the memos they write, or representing clients before the IRS, it's the client's decision on how aggressive you want to be. And people always think in accounting and particularly in tax, it's 17 or 17 and a half. Ladies and gentlemen, it's neither, it's both, it's something in between. And that's our business. That's why this business is the most fascinating business in the world. I am a 21st century confessor, and I don't have to be somebody.
But I also think that these returns could illustrate a very important point for our BAE students, that business form does in fact matter. Do you want to have, there are business considerations other than tax that, as tax advisors and BAE students and accounting students, you have to take into account. And one of those things are the liability issues that you could have exposure to as a self-employed person versus operating in an LLC. The last chapter that I teach in the fundamentals of tax, we go through, unfortunately we spend time talking about things other than tax, but we talk about the business decisions, why you would choose one type of business form over another, and this is a great way to illustrate that. And that you can actually have multiple business forms, and this is a great illustration. You can have an LLC or just be self-employed. You could still put all of that on a Schedule C.
Under the law, I won't call it.
It's different.
It's all different. Yeah, everything is different. All of life is different. But weirdly, just a little bit.
Yeah.
Depends on your life. But I took the Clinton Schedule A, and going forward, only about 10% of Americans will have this form attached to their return. Now, with the $10,000 self-limitation and the $750,000 limitation on acquisition that was for home mortgage interest deductions, and a lot of the other elements, only about 10% of Americans will have this form attached to their return going forward.
There was just a report as I was coming in here that found that 20 million people will no longer be making and taking the Schedule A for charitable contributions. It was just released this morning.
Yeah,
as a result of.
Yeah, you might not claim a charitable contribution because
you might still make one.
You might still make a contribution. You don't get a tax benefit on because of standard deduction. But the reason I pointed this out is the Clintons donated different kinds of charities, what we call 50% charities. We have a chapter in the book that talks about different charitable contributions and the AGI limitations. The 30% limitations to the foundation that you see there, they gave $3 million to, and then the 50% charity to the church and the high school that they went to. So there are different AGI limitations on it. Now, clearly, their AGI is so high that 50% or 30% AGI limit is not going to get away with it, pay the full deduction. But it is, I wanted to point that out in that case. And I guess I think, do I finish off the pens?
We also have the 8829.
Oh, yes, thank you, Jordan. At the last minute, I included an office and home form. The Clintons have an office and home deduction. We believe it's about $900 for the part of the home that they're using for their businesses. Maybe that's the home that burned down recently. I don't know.
That's where the servers are.
But and so that was, I found that very interesting that they would have an office and home deduction. People ask about that all the time. The office and home deduction. I assure you, does not lead to major tax savings for reasons I can explain. But I thought that was very interesting, and we have a portion of the chapter in the textbook that talks about office and home deduction. We can slap this up and get some conversation going about that. Let's turn to middle class America. Okay? The next one, this is truly middle class. There's just no question about that. And the reason I selected that is, first of all, you will note the student loan interest. And the reason we didn't see any student loan interest, presidents go to college, they borrow money, but their HEI is so high that they don't get a deduction for it. The student loan interest deduction is phased out based upon relatively modest levels of adjusted gross income. But the Pences, being relatively modest, they were able to claim the $2,500 limit on student loan interest. And so we want to mention that in our classes. That's an important deduction from an education standpoint.
I was doing that's for their kids.
Oh, yes, I would assume it's their children. Yeah, I would assume.
And that has not been eliminated.
No, that was on the table to be eliminated, but it wasn't done. The other interesting point on the Pence return, and why I like it so much, is the education credits. You will notice that there's a $3,000 education credit there on line 50, and indeed another $2,000 education credit on line, 88 perhaps, or 68. The point you go over those credits, why you put one number on one line, another number on another line, is that $2,000 is what we call refundable. Had their tax been less than the withholding and that credit, they would have gotten a check. I wish we could have had a president that would qualify for the earned income credit. Anyone doing community tax aids downtown this year? We're working on that. KSB, we have a course where the students will volunteer to do tax returns to low-income Americans downtown. It's a lot of fun. And I tell them, the issues confronting the wealthy are no different than the issues confronting the poor. They both lie.
Do you have any reports that says additional scrutiny?
No. The EIC information we all do independently. Community tax aid plus that. But when I was chair of the department, they asked me to, first time I was chair of the department, they wanted me to grant credit for that. Absolutely not. That's a job. That's an internship. Absolutely not. And then they bring me back to journals, where they prepare the tax returns for the low-income American and the story of their life, and the children and the problems, and the refund check they get is the biggest check they get other than making their paycheck the entire year. After I stopped crying, I gave 1 or 2 credits, depending upon. So we grant 1 or 2 credits for participation in the community. And they learn so much because they are on the other side of the table of a taxpayer, of a client, and they're in charge. And they're 18, 19, 20 years old, and they're in charge. Well, we have a supervisor, but it's their client, and they make the call as to what to do. And the important thing that they need to learn is sometimes Americans have to pay too much in tax, and it's wrong. It's unfair. So what? We analogize that to the fugitive movement. Next year's presentation will be on using movies in tax cases. And in the fugitive, remember when Tommy Lee Jones is finally caught up with Harrison Ford and he's going to jump off the television and kill himself? And what does Harrison Ford say to Tommy Lee Jones? I didn't kill my wife. What does Tommy Lee Jones say? I don't care. Because I'm a marshal and my job is to capture you. And whether you're innocent or guilty is relevant. It's exactly the way our students should prepare the tax returns. Follow the law, obey the law, do whatever it is, and if it ends up in injustice, let's change the law. And so that's what we try to do in class. And again, Pence being middle America, we try to demonstrate here a refundable credit as long as a regular credit. Finally, in the time we have left, I turn to Representative Ryan, Paul Ryan, and I chose him. And why he released his return, I don't know. He running for president?
Vice President.
Vice President? Oh, that's right, Vice President. Paul Ryan had filed an amendment return. And I keep picking out examples of where the tax return preparers screwed up, you know? And they must have gotten a K-1, a partnership form, you have a distributor share, and they misidentified what tax return income from the K-1 should go on. And so you cleaned it up real quick. John Kerry did that when he was running for president. He sold a painting on his return and paid capital gains tax. A painting is a collectible asset that has a special tax rate opposed applied to 28% rather than a 15 or 20%. So he quickly, the press picked up on it real quick. And the candidate for vice president or the candidate for president, I do not fault them for mispreparing their tax return. high fault for a tax return preparer. We tried to look this person up, didn't we, Jordan? We tried to find that.
There's a lot of people under that name.
Yeah, okay.
I would need to do some deeper research.
But the story is, they're human. They're human. And even the tax return preparer is human. I'm just like you. And they missed this. They missed the K1. But you clean it up, you pay the tax, you pay the interest. There's no penalty on that since you step forward to make the adjustment. We have a few moments before we have to take the evaluation for this. Caroline, you wanted to say a few words about the legislative update?
Oh, I just included a really brief legislative update given Donald Trump's departure from established disclosure norms that have been part of our political discourse for the past 40 years. Congress has responded both in the House and in the Senate. And in the Senate, the ranking member of the Senate Finance Committee, Ron Wyden, together with 20 of his colleagues, introduced the Presidential Tax Transparency Act that would mandate the release of returns of candidates for president for up to 3 years. There is a counterpart measure that has been introduced in the House of Representatives with 28 co-sponsors, that is the Presidential Disclosure Act. Also, on the state level, states have attempted to include measures that would preclude a candidate for the presidency from being on the state ballot if, in fact, they don't disclose their presidential tax returns. This was something that was actually passed by the California legislature, and Jerry Brown vetoed it, finding that it would likely be found to be unconstitutional. A similar measure was promulgated in Massachusetts, and I think there was also one in New Hampshire and Vermont. So that's just the latest update of what we have with respect to changes in the legislative requirements for the disclosure of presidential tax returns. And with that, I think we can take questions.
Yeah. Any questions? Yeah, sure. Stacey?
Do you talk about sort of moral obligation to pay taxes? I mean, do you go into it's a good cat tax?
Well, I follow all the Wendell's Holmes. I know he liked paying taxes, he liked buying civilization.
Well,
But Leonard Hand responses to that, no one should pay more than they have to.
I took taxes out of my kids' allowance to teach them that, and that taxes went to a pool that we then went to the movies. So
Cool.
it was taxes, for the greater good.
So I start off my entire lecture illustrating what taxes are and what they go to and what we
Right,
pay.
exactly,
And
people don't understand.
I have a comprehensive budget analysis that I do in the very first lecture to explain these are the budget priorities that our taxes pay, because as Oliver Wendell Holmes said, taxes are the price we pay for a civilized society. And the way that I approach this with our students is my goal in my classroom is to give my students tax confidence. You should understand in the media when they talk about tax policy, the decision making that's going on, that these are not arbitrary decisions, and that your responsibility as being an informed member of society is to understand your taxes, what is on that form, and you might not be able to do the math, you might not be able to calculate a complicated foreign tax credit, but you should have tax confidence and understand broadly the policy implications of tax policy. So that's how I approach that.
So my students are a little different because they're law students, and so they're in a law class, they're not in an accounting class. They're pretty open to the idea that obeying the law is something. But that's also in a context in which they're part of what we're teaching them is about thinking strategically about the law and how to define it. And so there's a whole balance in there about what kind of obligation do you have and what's your obligation as a representative as opposed to your obligation as a taxpayer. So I actually spend more time assuming that the obligation to pay taxes is something that we all understand, and then we talk expressly about these ways of thinking about how that burden is shared, both what we call horizontally among people who have similar incomes and among people who are very different. We spend a bunch of time in the first class. We have this thing called the tax policy game, which is everybody is thinking about how you would, like your kids, how you would divide up a pie that is spent on the public good among different participants who have very different.
Yeah, please.
I think that comment that the tax system is an incredibly political animal. It is the way in which our government over time has decided to encourage or discourage activities and to reward or punish in effective consistency. The international comparisons that you've done, I was a little confused by your comment. U.S. tax system is certainly unique, but I lived in Croatia for many years, worked in Croatia for many years, and we had to file individual income tax as well. It wasn't nearly as
The major, and I'm no expert in this, but the major source of revenue for most foreign countries, at least in the developed world, is the value-added tax. And we had a unit on the value-added tax in our policy class, and my co-instructor, Evan Whittier, who was born Hatchet, LA, said, take it out. It's not going to happen in this country. Nope. It was very interesting. And as far as policy, I'll just make this note. We invited the chief tax lobbyist for Deloitte to come to our class and talk about tax policy. And it was tax, we had one slide on the screen, bold letters, here's the tax policy of America, the next election.
But to clarify, I mean, obviously, lots of countries have income taxes as well, and income taxes sometimes include self-reporting requirements as well. So there are countries where all of the information that they need to know how much income tax you pay, the government has access to because of the report. But the majority of countries do not have that. You have to file a supplement of the return that informs them, like we do in the U.S. The balance of those things is very. The U.S. the balance is much less third-party reporting for people like Donald Trump. But yeah.
So you said that the Joint Committee on Taxation can compel the president to release his taxes.
Right.
So why haven't they done that?
Because the Republicans are the majority party in the Senate and in the House of Representatives.
So the Democrats on the committee cannot.
It has to be a majority vote. A majority vote, and given the current makeup of the Senate and the Senate Finance Committee and the Ways and Means Committee, that is not a vote that is going to be scheduled to be taken.
So could that change with the 2018 elections?
Yeah.
Okay, good. I just wanted to support everything you said because the majority of the American public like paying taxes if it means good schools, parks, firefighters, police, and we always lose sight of that in policy discussions in the press. Everybody acts like taxes are fun.
I mean, it's really, taxes are one of these things where it's very hard to ask people good questions about them. And so if you look at polls about people's feelings about taxes, it's unbelievable the range of types of responses that you get. So, yes, people express strong enthusiasm about participating in government through paying taxes, and they express strong enthusiasm about themselves paying the lowest taxes possible, or about there's sort of a whole range of what feel like conflicting views that people have when they think about taxes. It's hard to get your mind around, something that is both systemic and individual in such a direct way. So, I mean, with my law students, one of the things that I emphasize is that if you think about the way the government impacts you directly, paying taxes is one of the most, paying taxes is a compelled payment. So the government forces you to give up your money to it. When you're walking, most of us, when you're walking around in the world, don't have those kinds of encounters with the government. So you can imagine that would create strong feelings because there's this moment when the government is really directly involved in a way that you can feel the loss to yourself because you had that money and now you don't have it and the government is overseeing it. So it produces lots of strong feelings in a lot of people.
I can personally attest to that.
Americans are funny about tax. Do we have a couple more questions?
We have until 12:15, right?
I'm supposed to end this at 12:10 so you can do the evaluation.
Okay.
Oh, we got the
Can I
evaluation.
ask you two more questions? So,
What I live for.
so they have limited now the salaries that nonprofit executives can make to $1 million?
They have to pay a tax when they pay more.
Oh, I see. Okay. And our charitable donations are no longer deductible.
No, they're deductible, but it is likely because they expanded the standard deduction. For a lot of people, they will no longer be itemizing, which means you don't have the opportunity to deduct them because you deduct them as an itemized deduction.
And how long will we live with this tax?
So here's what's interesting. It's a very fluid state of affairs, and everyone will readily admit that there were major errors that were included in the tax reform bill, and there is a general political consensus that both the Senate Finance Committee leadership, the majority, wants to go back and make certain changes, particularly on the international side, with respect to the tax reform bill. And when you have to go back and make changes, they're no longer going to be able to do that under a reconciliation process, which is the 51 vote threshold that they adopted to specifically pass the tax reform bill. By having to go back and make changes, they're going to have to go through regular legislative order, which means that they're going to have 60 votes to overcome any filibusters that are raised by Democrats, which presumably would be raised by some Democrats. So it is going to be very challenging to get another tax bill done because there's just not a consensus with both, there's not a bipartisan consensus on how to move forward. But I would suspect that should the makeup of the House and Senate fundamentally change as a result of the 2018 election, I would suspect that if the Democrats are smart, the first thing they'll do is put together an infrastructure package, and they will pay for it by making changes and raising revenue from the tax reform bill and send that to the president for consideration. That's what I would think would happen.
So, any quick comments on, since most of us are wage earners, on the withholding tax challenges that are facing us?
So the withholding tables were just announced earlier, and you will probably have a much more generous withholding in your paycheck. And obviously, any tax advice that we provide you from this table is just general commentary. Unless it's gone. They'll take your money and give you tax advice. But you should be very thoughtful. You should be very thoughtful about those withholding arrangements because in 2019 you could be in store for a very rude awakening when it comes time.
But, and I heard there was also some new announcements yesterday about going back to your employer if you thought you were withholding correctly.
You can always do that.
Right.
But they will take the number off the circular E based upon your income and number exemption. The issue was, were they going to make us all do new W-4s? They decided not to do that.
And the concern about that is that will, in a lot of cases, that might have them under withholding. That's the concern about it. So over with.
No.
Under withholding.
Under withhold, so that in 2019 when you go to pay your 2018 taxes, you don't get a refund.
Right.
You have to pay more. And if you own your house, keep in mind that the salt deduction has been limited, and there are other.
So see your tax advisor now.
If you have a tax advisor, you can ask advice of. You can ask them. Do you think I'm going to be under withhold from? I'm sure they're getting literally 1,000 calls with that question.
That's a very hard question. We're not here to talk about your life, my life.
Can I say one more thing before we?
Sure.
So I just wanted to say one of my. I'm very happy that somebody listens to this panel. One of my goals about coming over from the law school to be on this panel was just to say I hoped to illustrate, though I don't think I did, that there are ways of thinking about taxes that tie into lots of things that lots of people are doing on campus. And over at the law school, I'd be really happy to come to anyone's class if anyone thinks that they're talking about distributive justice issues or I'm not an expert on the politics stuff, so I couldn't talk about the politics stuff. But Carolyn is, so I didn't mean to offer you to go and do class, but if anyone is talking about any issues for which some sense of the concrete details about the way we deal with government distribution or extraction of money from us, I'd really be happy to talk with you about how we can do that and do that.
Okay. Well, thank you very much for all coming. This was fun. I hope you enjoyed it. The tax is not a mundane exercise.